All right, so in this problem, I kind of wanted to show you the relation. So we're looking specifically at part B here, preparing a schedule of cost of goods manufactured and sold. And I kind of want to relate the schedule of cost of goods sold and manufactured to our T accounts that we can see and use. And there is a little difference, so I want to make sure that we notice and see that when going through this type of problem. So you can see I've already filled everything out. And luckily this is being recorded. So you can pause, you can stop, you can rewind. So if it goes a little too quickly, you can come back and you can get these numbers down on in your notes. Specifically, everything in red has come from our little schedule over there, and I just kind of put it into the T accounts. But we didn't have any beginning balances in our inventory accounts, which was materials, work in process, and finished goods. So you notice all the beginning balances are zero. We purchased some materials. We didn't have any freight in. However, if we had freight in, that would have also increased our materials account. And they tell us we use direct materials, so notice that flows directly into work in process, that $480. They told us that we had direct labor of $720. And then we get into the part that's a little different from the schedule. So if you notice over on the schedule, we have overhead. And in the schedule, we have $360 over here. So if you notice that. But in mine, I have $294 put into my work in process account. So remember, when you're looking at your actual books, the applied amount is what goes into work in process. And then eventually, any over or under applied overhead, in this case, we were under applied by $66, that gets closed to cost of goods sold. Okay, so if we're under applied, that means we didn't apply enough cost. So when we fix that problem, our cost should increase. And that's exactly what is happening here. Our expenses are increasing because expenses go up with debits. All right, so that is the big difference between a schedule and using our T accounts. The schedule uses your actual overhead amount, whereas if you're doing T accounts, we apply the overhead into work in process with our applied overhead. Okay. Eventually we get the same amount of numbers, but I definitely wanted to point that out to show the differences between if you like T accounts and you're using the T accounts versus the schedule of cost of goods manufactured and those differences there. Okay. All right. Now, in this next problem, we're going to briefly talk about, I think each part we'll cover really quickly. The first part wants you basically to say, what is the sales mix? So we've got two products here. We've got power and we've got light. And if you'll notice, the budgeted number of powers is 160. I have that highlighted for us. The budgeted number of light is 640 for a total number of products of 800. So to get the sales mix or the proportion, you would simply divide each number by the total. So 160 divided by 800 is 20%. 640 divided by 800 is 80%. So that would be our sales mix. 20% power, 80% light. All right, the next part of this problem was to determine the weighted average contribution margin per unit. So to do that, we're told that the contribution margin per unit for power is $180 per unit, okay? And the contribution margin per light is $120 per unit. So if you multiply each one of those by their percentage, you will get their contribution margin or their contribution to our margin, okay? So power was $36 contributing to our margin, and light is 96. If we add those together, we get 132 as our weighted average contribution margin. All right, so let's look at D. We're going to skip C. We're going to do C, but we're going to skip it as far as slides go. All right, so if you look up at C here, I've got it highlighted. To find letter C, which is break-even point in units, our formula here when we have more than one product is fixed cost divided by the weighted average contribution margin per unit. So that's a little bit different when we only have one product. If we only have one product, then we wouldn't have a weighted average, right? We would just have contribution margin per unit. But since we have more than one product, we have to have that weighted average contribution margin per unit. So our fixed cost up here we can see is $66,000. So we're going to put that into our formula, $66,000, and we're going to divide that by our weighted average contribution margin that we found on the prior part, which was 132. When you do that math, we get 500 units to break even. Now, that's part C, okay, which we kind of skipped. Part D, which is what we have on the screen right here, wants us to know the number of units of each product to break even. So we've got to break that 500 out into its respective parts. So how many of the power and how many of the light? So if you simply multiply the total number of products to break even by its respective percentage, then you get the number of each product. So power comes out to be 100 units to break even, and light 400. So there's our 500 total units. 100 of them have to be power, and 400 of them have to be light. So in part F, we're asked to calculate the margin of safety percentage. So we're actually going to need to calculate the margin of safety first. And so that is right here. So margin of safety is equal to our revenues minus our break-even revenues. So if you look up in our problem here, we have $368,000 in revenues. So that would be our revenue portion. Our break-even revenues we can get down here kind of in a part 2 situation. So we found earlier that we needed to sell 100 of the power and 400 of the light. If we multiply that times their respective sales price per unit, we get their contribution to our break-even revenues, which is 50,000 and 180,000. You add those together, you get $230,000. So when you subtract your break-even revenues from your revenues, we get a margin of safety of $138,000. So now we can find our margin of safety. So margin of safety is represented as a percentage of revenues. So if we take our margin of safety and divide that by our revenues, we get 0.375, which is 37.5%.